Okay. Good morning, everyone. Everybody seems to be logging on. Hey, Jim, I can see you. Can you hear us today? Awesome.
Can you hear me?
I can hear you now. Yes.
Great.
Welcome.
Thank you.
Looks like we've got a few more people. It's taken a minute to log on. We've got a few more people that it's taken a minute here. I don't know. Things must be slow today.
It's rainy out there.
Yeah. Computers want to say, I think it's a nap time right now.
Computers.
Yep. Uh,
Yeah.
all right. So it is 10 o'clock. So I do appreciate you all being here. And I would like to go ahead and get started. I do want to welcome both Don Hobbs and Don Taylor from Front Range Business Inc., talking about understanding a business valuation. I know this is so important when you're either going to look at buying or selling a business. So I really appreciate them being able to come on and talk to us about that. That being said, Don Hobbs, I think it's on you, so I'm going to go ahead and give it back to you.
Great. Well, thank you, Becky.
Hmm.
And everybody who's joining today's program, certainly a great big welcome to you. We're glad to have you. And, at Front Range Business, which has been around for a long, long time, over 30 years, we always appreciate the chance to share our experience um, about business valuation or buying, selling businesses in general through the Larimer SBDC. It's a great organization. You guys do wonderful work. I know you do a lot of work for entrepreneurs looking to start businesses from scratch. And one of the things that we talk about, we'll talk about a little bit today, we talk about it in our other programs, is that build versus buy approach. So, if you're starting a business from scratch, you're building that business. If you're coming in and taking over somebody's business and buying it, it's a different approach to being an entrepreneur. So I think that theme will come out. Um, Also want to add that this is part of a three-part series. First part was last week, which was an overview of the entire selling and transaction process. There are 9 steps to that, and was recorded and is available for replay on the Larimer SBDC site. Becky, are you able just to describe what they do to go in and see that?
Yeah, so actually, it would just be easiest if you give me a call or email me. My phone number is 970-204-8600. You know what? I'll just add my info in the chat. So reach out to me and I can get it to you.
Okay, great. That's fantastic. Because it's good to see the overview. What we're going to do today is dig a little deeper into valuation itself, because that's a key component of being able to get any business on the market and establish that market value for sellers who are going to be exiting the business and for buyers coming in. So I'll just do a quick bio on myself. I've been in Colorado over 50 years. Primarily in the Boulder County area, but I've spent a lot of time from Fort Collins down to Colorado Springs. And I'm about to enter my 10th year as a business broker with Front Range Business, having sold 3 of my own businesses over the past 30 years, and also working in the corporate world for a number of years. So, as a broker, I've interacted with hundreds of sellers. I've interacted with thousands of buyers. And what we're doing today is really a distillation of the experiences that we've had. And I'm partnering today with one of my fellow brokers, Don Taylor. Don, can you add a little bit about yourself?
Yeah, you bet. Good morning, everyone. It's good to be here with you. Um, yeah, so Don Taylor, my family lives up in the Windsor Fort Collins area. Don and I are both listing brokers, and you'll learn more about that as we go through the series. And so 30 years of business ownership for myself. I started in my early 20s, and between building, buying, and selling my own businesses, our family businesses. And then I've been a broker for the last 10 years full time, helping people buy and sell their companies. And it's a true joy. I do it because I love it. I wish, when I started, I had a mentor like Don Hobbs or someone like that to help me understand all these moving parts. So my education along the way was costly at times, just having to go through it. So part of our goal here today is to help you understand a little bit behind the scenes how these things work and try to make your life a little bit easier. So I'm glad to be here with you. And Don, I'll let you kick us off.
Great. And I want to add, if at any time you come across any questions that you would like to have answered, just go ahead and send them through the chat feature, and we'll pick up on them. We might say, oh, we're going to cover that in a minute, or we might be able to jump right into the question, but just feel free to send them along at any time. So we have 90 minutes. We actually now have 84 minutes left to cover everything that we have to do today. So we're going to move fast. I always emphasize this is not a how-to. You won't come out of this fully educated, ready to necessarily value your own business, but you will understand what is going on when valuations are put on a business. We don't just reach up and grab a number out of the air and say, that's what we should value this business at. There's a set of processes that we go through. And so we're going to move fast, but let's go ahead and hit that next slide, Don, and talk about how we're going to put the program topics together today. So here's what we'll be covering. First of all, we're just going to set the table. We're going to give you some general concepts of valuation so that you understand kind of what's going on behind the scenes. We also want to talk a lot about why are buyers coming to the table to purchase businesses? What's their rationale to invest? And what are they expecting as buyers of a business? We'll talk about primary elements of a business sale. By that, I mean, what's actually included in a transaction? How is it structured? And then ultimately, we're going to wrap up with a test case where we're going to take a business and we're going to go through a valuation exercise for that. And you'll see at the end exactly what we did and what kind of numbers it generated. So that's what we're going to dig into. So let's set the table a little bit. Don, if you could advance the slide there. Yep, we'll go on. And we talk a bit about small business. It's the SBDC, right? And so small businesses mean different things to different people. And we really come at it as brokers from those businesses we see. I'll jump down to the last bullet on this slide. We typically see businesses in the $1 million to $10 million in revenue. And we think of those as small businesses from a business broker perspective. But if you were the SBA, the Small Business Administration, you might think anything under 1,500 employees is small. Even though 90% of US businesses have less than 20 employees. So it's a bit of a broad category, but as we talk about small business, we're talking about that $1 to $10 million in revenue, which is probably also what sellers that are on this program with us today might have their businesses generating in revenue, and what buyers who are looking to buy might be thinking that's the size company that I'm looking to acquire. So, those are the most common numbers we see. There are certainly businesses smaller than that and larger.
Absolutely.
This is a slide where the themes are super important to understand. And that's the value of a business qualitatively versus quantitatively. And, I bring this up because sellers are going to think qualitatively. Imagine a seller, they've been in their business. Maybe they started it from scratch. Maybe they purchased it under whatever terms. They may have owned that business for 20 years, 30 years, 40 years. They're attached to that business. And that's what we say by qualitative side. It's not the hard and fast numbers, but it's the concept. It's the type of business that it is. And so, that seller maybe has a community of customers. They oftentimes have a set of employees that they feel are like family. They might have suppliers who they've been working with for years and years and years. And, they think about that every day when they walk into their business. They're surrounded by these feelings, these qualitative feelings of why they enjoy being there. They've been building it for years to put it together just the way it is. And, there's a brand, there's a reputation, and that seller might have an identity in the community because they volunteer on various boards or with various organizations. They're members of the Rotary or the Kiwanis, or, they're known in their community in part through their business. And sellers, that's where they start, even though they have to list their business and put a price on it. They're coming from the place where they know and feel these things. Buyers aren't coming from that place at all. They don't know that seller's 20 or 30-year experience. They're going to look at this business cold. They're coming at it with no knowledge of any of that. And so they're going to be thinking quantitatively. They're going to be thinking, if I step into this business, what will the amount of economic benefit that flows to me be from taking over this business? What are the risks that I'm going to face if I take over this business? What harm could come to me if it's not successful? And they're going to always want to know, hey, I have lifestyle requirements. I want to get a return on my investment. Will the price I pay for this business and the economic benefit that flows to me from owning it, will there be a balance there? Will it be appropriate? And, that's not about what boards I'm serving on or, how wonderful of these employees that I once loaned $10,000 to help buy a car because they were in need, or I did this or that. They're really thinking about the numbers of the business. And that's where it has to all come together. Okay, so let's see what else we've got here. Let's talk about the sellers. They have this qualitative feeling about their business and they go in every day feeling good about it. But, ultimately, they come to the end of the line. They come to the place where they are going to sell an existing business. And we divide up the reasons into two categories, the wonderful R's and the dreaded D's. So the wonderful R's are all very positive reasons to sell a business. I'm going to retire after a great long career. We're going to relocate as a family because my spouse got a job in another city, or we want to be closer to our families as we age. Or maybe I came across a business opportunity that I want to reinvest the profits into a new venture. All very positive reasons, and all reflect the fact that something has changed. Businesses typically aren't sold if nothing has changed. They just roll along. Bad reasons, I'm not even going to read them. You can read them for yourself. As a broker, we've seen them. We've seen them too many times. We're sorry for these circumstances that can befall the owner of a business that causes them to feel like they need to sell it. But this is real. It's real life, and this happens. And so, again, those changes, those things that have impacted the sellers can cause them to sell a business. And so there you go. And we'll move on and look at, this is a test question. So I want everybody to look at this and we'll see how well you do. Which of these are true? Owners, lenders, and buyers see the business differently. Do they see it differently or do they see it the same? In my business, traditional valuation rules don't apply because, and then the seller gets to apply their own personal rationale for why their business isn't like anybody else's business. Buyers will pay extra for future potential. We call this the all you have to do is ... rationale that I can show that there's lots of future potential, and so buyers would pay extra for that. Strategic buyers pay more. What's a strategic buyer? So we say a financial buyer is somebody who wants to take over the business and operate it basically the same way the owner is today. Single owner, running the business, taking the profits out of it, standalone, doing its thing. Strategic buyer is somebody who maybe has the same type business in another city or is looking to expand their product set or geography or something that they want to do to kind of roll the business up under what they've got. Are those strategic buyers going to pay more? More physical assets means higher value. By that, I mean you're in a capital intensive business. You maybe have a lot of tractors and asphalt paving equipment or something that's quite expensive. You have to have that to run your business. Whereas another business might make just as much money without all of that equipment. Is it the equipment that makes the business valuable, or is it the profitability of the business that makes it valuable? Value is different from price. Is that true? Or are price and value always exactly the same? And then, of course, when you're going to market, is it true that the best strategy is to just put that price up there as high as you can? And if you don't find anybody, lower the price. So those are the questions. You probably answered them for yourself. It turns out there were only two true statements on that slide. Owners, lenders, and buyers see the business differently. Absolutely. We talked about qualitative versus quantitative. Even within the quantitative, the lenders who are going to get involved in that business might be more critical of that business than a buyer is. They might be more supportive of the business than the buyer is. But they will probably see it a little bit differently. Traditional valuation rules will apply to almost all businesses. I can think of some exceptions. If you are in the tech world and you have an app that you're going to sell to Google, that's different. If you're in the natural food products business and you've got something that you've rolled out, King Soopers now has it in 1,000 stores, and you're going to sell it to Pillsbury, that might be different. But if you're selling a traditional Main Street business, those traditional valuation rules will apply. Buyers won't pay you for the extra potential. Let me go back just one there for a second, Don.
I apologize. So sorry.
Buyers will pay extra for future potential. No. If they're going to invest and they're going to drive that future potential at their own risk and with their own money, they're not going to pay you for the fact that that opportunity is out there. They're going to pay you for what you've accomplished so far. Strategic buyers, I have never seen a strategic buyer pay more. I have seen strategic buyers pay the same, and I've certainly seen them offer less. And one of the reasons strategic buyers can offer less is it's a very discretionary purchase for them. They don't have to buy that business. They just buy it if the terms are right. So they often will come in with the lowest offers of any of the buyers that are out there. More physical assets means higher value. We're going to talk about this a little more, but there is a saying, assets exist to generate profits. And by that, I mean, no business can generate profits without certain types of assets, the ones that meet the needs of that business. If you happen to be in a business that needs more physical assets than others, but you generate the same profitability within a reasonable range, your businesses are going to be worth the same, not have different values. Value is different from price. To bring that home, Value is something that we're going to calculate on the front end, looking at your profitability, looking at other comp sales, looking at a variety of things that we'll be talking about today. Price is what you put it in the market at. Price might be lower than value because you have one of those dreaded D circumstances and you need to sell off the business a little faster. Or you might be more patient and willing to take a little more time. You're going to price it a little bit higher and see if you can get that. So yes, you can move from value to a different price, and there's reasons to do that. Best strategy, is it to price high, then lower it? I see that Jim Ditzel has just raised his hand. He probably has a question. And Jim, you're a real estate guy. You probably know the strengths and weaknesses of putting a commercial property at too high a price out in the market. Is your speaker on?
Oh, your microphone looks off, Jim.
There.
There you go.
Yeah,
Hi, Jim.
Hey, Don. I just was wondering, does value, is that a qualitative measure more than a quantitative measure, the way you're talking about it? Is that an example of it?
No, value is primarily quantitative, but we are going to talk about value influencers, characteristics of businesses that can change their value, and those do fall in qualitative categories, some of them.
Okay. Yeah.
Yep.
Good.
Okay, let's keep going here. We're going to make sure we stay on time. So shared vision. We use this slide just to emphasize, depending on which side of the table you're on, you might see that as a 6, you might see that as a 9. And so the ability to come together and understand what the other party is doing is really part of how this whole shared vision comes together.
Okay. Well,
okay, over to Don Taylor.
Yeah, Don, thank you for that. That was great. And we're gonna circle back and touch on some of the key points that Don was making there through the rest of this. So let's look at this from a buyer side, right? So it's hard sometimes for sellers to understand maybe where the buyers are coming from. So we're just going to help you see a little bit behind the curtain where they're coming from and what you're competing with and how they're rationalizing making an investment in your business that's for sale. Don mentioned earlier, there's really two main types of buyers. There's the buy or the build type. And so as Don mentioned, this presentation is all really based on acquiring a company. This is a great slide. It's one of my favorite ones. So return on investment. Okay. So when businesses are being sold, they're in competition with a lot of things from a buyer's perspective. Okay. So I mean, we look across the screen. We probably, everybody here probably has investments in one, if not multiple of these buckets. Okay. So on the left side, right, where the risk is lower. Okay. First of all, those are going to be passive investments, money markets, all the way up to stocks, right? We're going to put our cash in there. And by the way, that's worth noting too. All of those investments on the left, the 4 on the left, those are all our dollars. Okay, 100% of our money is tied up into those. I guess real estate's going to be a little bit different there, but we're putting our cash in there. On the right side, middle market companies, small businesses, we're actually able to leverage SBA, for example, and increase our investment and increase our potential with that. So on the left side, lower risk, lower returns, okay? And really don't have to do much typically involvement in those. On the right side, maybe we're a little bit more involved. Higher risk, but the rewards are much higher. And so for small business, you'll see here on the right, because the owners are more active, because they can control their destiny, they can put their footprint right on that business and impact the outcome. The returns are just much higher. And so what we, as brokers, we don't typically see a person, I'll just use simple terms, with $1 million. I know it's a lot of money, but if it's $1 million business, we typically don't see a cash buyer come in and put all million on that and pay for it and then have their money there. Usually what we'll see is someone with $1 million wants to buy a $4 million business and they want to leverage an SBA loan or something like that to increase the size of the business so they can ultimately increase their returns. But For small business, we're targeting 25 to 100% returns on investment. On average, you want to see getting your money back in about a 3-year time frame. Depends on the size of the business and multiple. We're going to learn more about that through the presentation. And Don, I just want to give you an opportunity if there's anything you wanted to add on this slide, because it's an impactful one before we start diving into the nuts and bolts of how we put it together.
Well, only that as buyers look at this, and I go to that lower right-hand corner where it says higher risk. Buyers, sellers, you know your businesses. You know what the risks are. You've come to terms with that, and you've built your operating structure around mitigating those risks. Buyers coming in, one of the top items on their list of analytics that they need to do is calculating that risk. And they're going to see lots more potential risk in a business than the seller maybe sees in their own business. So I just mentioned sellers, to get into that mindset and get your vision aligned with a buyer. Just keep in mind, buyers perceive risk and they operate from that perspective.
Yeah, thank you. So the business earnings, from a buyer standpoint, it's going to have to help us cover our loan payment. Typically the seller doesn't have a loan payment anymore. They may, but the buyer probably is going to have one. So there's a list of things that we're looking at from a buy side that we've got to cover before we get down to our own bottom line, which is our lifestyle and what we need to pull from it. So we're likely going to have a loan that we need to repay. Okay. When we buy this business, in most cases, the seller is taking all the cash out of the accounts with them. Usually they're asset sales, but stock sales and other structures come into place too. So not only did we need a loan to buy this business, but we're going to have some sort of working capital injection, operating cash. Like we've got to be able to run this company, make payroll, pay our taxes, and continue to reinvest in the business so it will grow. The business reinvestment side too, usually our sellers, they know they're selling, right? And they can plan for that. And so they've got it built up and we help them get it polished up and ready to go to market. Typically they're slowing down their reinvestments in their business because they're going to sell it. So when we buy it on the buy side, that's going to be an area we need to have more capital to do that. And then, as I mentioned, at the end of the day, we have our own bottom line. I understand that I'm going to have to make all these payments, but I still need to have money for my family. I still have a lifestyle that I need to maintain and bills I'm going to have to pay at a personal level. So there's a lot more to this than just writing a check and acquiring the business. And a lot of times sellers just lose track of this. So why do it, right? Why are people looking to buy an existing business? They want immediate cash flow. And we talked about the two different buy types, right? Build and build it, buy it. We're walking into immediate cash flow. We want to reduce the risk as much as possible. So we're leaning on the fact that the seller has proven the model of this business, and we can see that it's got transferable value. You're going to hear that term over and over today. We're looking to shorten the learning curve, right? So really, most buyers look at it as I've got a certain skill set and a capability, and I've identified the characteristics I want in a business. I'm hoping to be the fuel to add to this engine to take it to the next level from where it's at. So I'm looking to reduce my risk through vetting and my evaluation of this company. I want to shorten the learning curve. And I love the fact that it's going to have customers day one, internal and external customers. So instant market share means, again, we're not having to, scratch for every customer we're getting day one. We're actually walking into that. We're getting business specific training. So the seller really is the expert in their business. And from a startup perspective, we go through the mindset of everything and anything that could happen. We're having to, put time and energy towards that. Here, everything is very dialed in. We know what the historical financials look like. We know what the customer base looks like, the employees, the market share that they've got, what we intend to do there. And we can just dive straight into business specific training on how we can take this business over successfully, maintain it, and get it to the next level. And I'll just share with you, if you're a buyer, you have to have a mindset of partnering with that seller. We see it all as listing brokers. Those are the most successful transitions is when buyers are humble enough to partner with the seller and take advantage of as much as they can get from them in terms of knowledge and experience versus walking in day one and sort of blowing things up and trying to do it my way, even though it's been done a different way for so long. Potential to improve the business. Okay, I'll just tell you from my experience, every buyer I deal with is looking for a business they can make their mark on, one way, shape, or another. If buyers feel like the business is maxed out, it's marketing is as good as it can be. Sales couldn't be better. They're it may sound odd, but it's a deterrent. Buyers want an opportunity somewhere to make an impact on that business. So as brokers, we're looking to identify that too, as we're seeking the right buyers to come in and acquire this company. So we have the ultimate fit there for both sides. And then back to the investment leverage, right? So if I have $1 million, I'm not typically buying $1 million business that may be generating a couple $100,000 in SDE. We'll get to that. I'm probably going to buy a bigger business where I can leverage an SBA loan and have a bigger bite of the pie. Don?
Great. Thank you.
Yeah.
That was good. So, we're looking at a transaction here. We're going to be going into evaluation pretty soon. But before we do that, let's look at what actually happens. What are the primary components of a business sale? So let's start with the fact that we're going to be looking at asset sales. I'm not going to spend a lot of time explaining the difference between asset sales and stock sales, but think of it this way. You have an umbrella corporation, an entity. We'll call it ABC Company, Inc. And ABC Company, Inc. has underneath it this operating business called the ABC Company. And that operating business has trucks or cash registers and customers and contracts and suppliers and websites and trade names and all those kinds of things. In an asset sale, you don't buy the umbrella entity, ABC Company, Inc. That stays with the seller. What you buy is all of those assets that are used to productively operate the business. That's an asset sale. In a stock sale, you would also get ABC Company, Inc. The entire entity would transfer over to the new owner by acquiring shares in the business, all of the shares of the business, rather than acquiring just the functional assets of the business. There are tax implications. There's other things that you'll need to know as you're looking at this in greater detail, but also know that probably 95% of small businesses are sold as asset sales. So the stock sale is the exception in a small business transaction. That's why we don't spend a lot of time on it. Okay. So we talked about sellers going to retain here's what's going to happen in the sale itself. Seller's going to retain their business entity, the ABC Company, Inc. Now, interestingly, they might keep the entity, but change the name of the entity to make it up. Used to be ABC Company, Inc. Right? And they've kept the EIN number, they've kept the entity, but they have just changed the name and they've transferred the name to the new owner. They're not getting the entity, they're just getting the name that was on that entity. And you do that for convenience, and that happens quite a bit. The buyer is going to take the assets that they have purchased, the assets, and going to put them under the entity that they own. We'll call that XYZ Company, Inc. So they might go start a new Inc., XYZ Company or LLC, and they're going to put all the assets into that. Now, some or all of the assets of the business are going to transfer. The reason I say some or all, a lot of times in a small business, the owner has a couple of personal cars that are on the balance sheet or that are in the business. There may be other small things that they're doing. Maybe they have a little side business that they're not really packaging with this. And so that doesn't go. But for the most part, all of the business assets are going to transfer to the new buyer. However, some things need to be resolved in the transaction itself. So, for example, if there are accounts payable that are due at the time of closing of the business, it's the seller's responsibility to take care of the accounts payable liabilities. Taxes that are due, it's the seller's responsibility to take care of taxes that are due up to the day of closing. If there's any pending litigation, certainly the buyer's not going to want to take on the risk of any pending litigation. So, all of those things are liabilities that the seller retains in an asset sale. And I put a little note here, taxes follow the assets. If the seller didn't do a good job retaining liabilities such as accounts payable or whatever, as the new purchaser of that business, you probably would not be legally bound to take those on, but taxes you are. Taxes follow the assets. So buyers want to be always really, really careful and make sure that taxes have been handled properly by the seller, because you will absorb those as you take on the business. Seller's also going to retain the cash. Don mentioned it a little bit earlier. The seller may have socked away quite a bit of cash in the bank account just by virtue of not having moved their profits out into something else. That stays with the seller. If the seller has sold things for which they haven't yet been paid, there are accounts receivable for those. Those will go to the seller even though they come in after the closing. And seller's going to retain personal items. It's very common. They say, hey, I want to keep my notebook, computer. I want to keep this car. I want to keep these kinds of things. Yes, those make sense. Deposits, gift cards, work in progress. Let's say you're a wedding venue and you've taken in $250,000 in deposits against weddings that are going to be held after the closing of the business. Those deposits don't belong to the seller because the services have not yet been delivered. Those deposits are going to transfer to the buyer. Same thing with gift cards. Some businesses have lots of gift cards. They can have thousands and thousands of dollars of actively traded gift cards. And it's the new buyer who's going to have to fulfill the requirements of those gift cards. So the value of those would transfer. Work in progress means, let's say you've got a company that builds things and sells them. You might have a whole bunch of half-built things. So seller, you've incurred some costs to get it to that point. Buyer's going to incur some costs to get it later on. Those are going to be negotiated in terms of where the value falls for that. So just kind of giving you some idea of in an asset sale, how you deal with some of these things when you get further on in it. Okay. So what are the four elements? Whether it's a business sale or asset sale or a stock sale, there's still four elements of a business. One is real property. That's where the business operates. One's tangible assets, personal property. That's the kind of equipment that's used in that business. One is goodwill or intangible assets, and we'll get into that in more detail. And one is working capital. Don talked about that. Working capital is the money to operate the business. So let's go in more detail on these. So real property, there's a couple of different things. Again, this is where the business operates, the locations where things happen. It might be a warehouse. It might be a manufacturing plant. It might be a retail store. Could be anything, but that's where it operates. So one scenario is that the seller not only owns the business, the seller also owns the real property. So they have an option. They could sell that to the business buyer. Hello, I'm going to sell you the business and I'm going to sell you the property. And those are typically handled as separate concurrent transactions. You only buy the business if you're also buying the building. You only buy the building if you're also buying the business. But they tend to be two different transactions. They might be one loan from the SBA, but two transactions contractually. Seller has another option. Seller can say, I'm going to sell the business, but you know what? I want to hold on to that real property. I want to become a landlord because I want that revenue stream as landlord for this building that I own rather than getting out of it. And in that case, the seller would lease the property to the buyer. It may be that historically that seller has not charged enough rent to himself as the owner of the building and the owner of the business. And so when we say rent may need normalization, what that means is that rent needs to be looked at in terms of what that seller is now going to charge the new owner of the business versus what they charge themselves historically. And if that's more money, that's value of the business. So we need to take that into account. Another option, and I'm just going to say up front, don't do this, sellers. But another option is to sell the building to a third party on the open market while selling the business to someone else. It's the most complicated approach. You're going to have parties with competing interests. The person wanting to buy that building is going to absolutely want to maximize its economic potential to the detriment of the person who buys the business. And so it could get really complicated. The timing could be an issue. There's more moving parts, more additional parties. I just have never seen this successfully handled in a business transaction. It's just, you could do it, but don't do it, is what I'm saying. Okay, I see Jim Ditzel making a face over there. Okay, here's another one. The building where all this takes place, where the real property is actually owned by another person. Most common is that the buyer comes in and establishes either a new lease or an assignment of the existing lease and just continues with that third party as the landlord. Just keep in mind, when you come in as a buyer, if you've got an SBA loan, the SBA is going to require that you have a lease duration that is roughly equal to the number of years of the SBA loan, typically 10 years. So if there's only 2 or 3 years left on a lease with the current owner, seller of the business, there's going to need to be some negotiation and establishment of a longer lease term, or else you can't buy the business because you won't get the loan. So all of these things have to work together. And keep in mind that leasehold improvements belong to the landlord. So sellers, anything you've done, you've added more air conditioning capacity, ventilation, you've put in more electrical power, whatever it is you did to that building, that's going to belong to the landlord, not to the seller. I have seen this where the buyer purchases the real property from a landlord. I have seen this. The buyer comes in and says, I'm really interested in that business, but I also want to buy the building. Would the landlord be willing to sell? And oftentimes we'll go to the landlord, or the landlord has already made it known that they're interested. And so there can be a transaction where there's a purchase of the business from one party and a purchase of the building from another. That happens, and that's not nearly as complicated as the reverse scenario we were talking about earlier. It is true, however, that the business seller is trying to get, the best price, best value they can get for their business, and the building owner is trying to do the same thing. Those two are in competition because as the price for the building goes up and the cost of acquiring it goes up, the value of the business goes down. So they always work like that. It's a teeter-totter, right? One side goes up, one side goes down. Okay, so that's real property with third party owning it. Let's move from real property to those physical, tangible assets, what's called personal property. Furniture, fixtures, and equipment is a big part of that. So depending on the type of business, you could have a lot of machinery. Let's say you're a machine shop or an auto repair shop. You could have field equipment. Let's say you go out into the field and you test leakage on oil wells. You could have tools, you repair things, you're plumbers. So there's a lot of physical assets that some businesses have. Most businesses will have an office furniture. Retail stores will have retail fixtures. There could be vehicles involved, trucks and the like, that you use to move products around or cruise around to the job site or haul equipment or anything like that. Those are all tangible assets, furniture, fixtures, and equipment. Those are going to be included in the sale, whether it's an asset sale or a stock sale. Those are going to be going to the new owner of the business. Another physical asset that goes to the owner of the business is inventory. So let's say you're a retail store. Another don't have to be a retail store. You could be a some small manufacturing organization. And so you've got a lot of parts that are on the shelf that are used to build the things you build. That's your inventory. Finished products can also be considered inventory. So that is usually transferred to the owner, not at its retail value, to the buyer, not at its retail value, but at its cost. And a specified amount is included in the price. A deal will be put together where the buyer says, I will pay you for $1 million for the business, which will include $150,000 in inventory. And when you get to closing, if there's only $125,000 in inventory, the price will come down $25,000. And if there's $175,000, there'll be an extra $25,000 tacked on because of the value of the inventory. Now, values of inventories change a lot, especially in a seasonal business. We see retail outlets that do a heavy Christmas business, for example. They might have $500,000 in inventory in October, November, December. And then they might have $150,000 in inventory in January, February, March. So, what time of year a business sells can have an impact. You want that inventory to be saleable. Old stuff that's just sitting around has no value. Buyers won't put any value on it, and sellers, you should be prepared to just write it off. And it should be at appropriate levels. Do you have the right amount of inventory for lean operations? Or do you have way more inventory that you need that won't be sold for years because you just have too much? Well, that's just going to tie up capital. So buyers are not going to be interested in that. So appropriate levels. And then I said this earlier, and I'll say it again. I repeat it over and over and over again. Assets exist to generate profits. You couldn't run your business without these tangible assets. The only reason you have those tangible assets is to put them to productive use to make profits, not to look at them when you go out into the yard and see all that wonderful equipment you have. If it is not generating profits for you, it's not valuable. It's just not doing anything for you. It's tying up capital. So assets exist to generate profits. All right, what do we have next? Working capital. Third component of what's included in a sale. So that's the money needed to run day-to-day operations, operating cash. Some businesses don't need very much. A restaurant, for example, is going to get cash payments every single day from its customers. It needs to keep a minimal amount of money in the bank for its rent payment, insurance payments, other things like that. It does not need to have a big store of working capital for some seasonal buildup or something like that. Manufacturing has a different working capital need. If you manufacture something that's costly to put together, significantly adds to your balance sheet, and you don't get paid for it for a long time, you need a lot of working capital to be able to move through that manufacturing process. So the type of business is going to determine what those unique needs are, from almost nothing to significant. Working capital in an asset sale, working capital is not typically included. By that, what I mean is the seller keeps all of their working capital, which is in essence the cash they have in the bank. They keep that. They take it with them when they sell the business and leave. And the buyer has to start over, bring their own working capital. So that's the most typical scenario. One small workaround that we sometimes see is that after everything's been put together, it's determined that it's better if the seller leaves some working capital for the buyer, some amount, and the price gets increased by the amount of that working capital. In other words, it's not included in the original price. It's an increase of the price. And you can do that if the SBA lender will support that increase in price. And they often will, because SBA lenders know that there has to be working capital or the business is going to fail. So working capital is part of their calculation. And it's just a question of where it's going to come from. Okay, so that's working capital, which leads us to the fourth and final part of what's included in a business sale, and that's what we call goodwill. Goodwill are all of these things that add to your ability to run the business successfully, but they aren't physical assets per se. They're not furniture, fixtures, and equipment. They're not anything like that. So, a business with a strong customer list or contracts, the trade names that you've developed that have a good reputation out there in the marketplace. You might have patents or intellectual property. Probably have a website. Most companies do. You may have strong social media activities. Those aren't things you can put a physical value on them, but they contribute to the success of the business. Experienced employees, quality of your location, documented systems and processes, all of these things contribute to profitability. And at the end of the day, it's the profits that are being sold. Yes, the inventory is being included. Yes, the website's being included. Yes, the vehicles are being included. But what the buyer is buying is your profitability and the transferable value of that profitability to them. So that's goodwill. Now, one of the reasons we bring this up, sometimes people look at goodwill. How much is my goodwill worth? And the answer is, it's on the next slide. Don's going to flip it up here. Goodwill is the difference between the selling price and the value of those physical assets. So we used that $1 million selling price example earlier. If the physical assets, inventory and physical assets were $300,000, then goodwill would be $700,000. It just is the difference. You don't add up all those components and try to put a value on them. You just simply look at the difference between the physical assets that are transferring and the price. And that's goodwill. And the reason for goodwill, recognizing that, is buyers are going to buy a business. Almost invariably, it's going to be with an SBA loan. And the SBA will loan on goodwill. A commercial lender without the SBA backing is going to want to collateralize physical assets, and they won't loan you more than they can collateralize. But the SBA will loan money on goodwill. That's their charter, that's their responsibility, and they do it. So goodwill is an important component of any business, and you can get a loan against it, which is far, far greater than a loan you could only get against the physical assets of a business. Okay.
So Becky,
Don's going to take us through a valuation exercise. Let's go.
Yeah, and if you need coffee or water, grab it, because we're about to enter the highway and we're gonna start making our way through here pretty quick. Becky, are there any questions that we need to address from what Don just presented for us? I feel like there were a couple that came through. Maybe we can get to quickly.
Yeah. So Mark made some comments. As a structural engineer, and his firm does architectural drafting as well. I have no physical assets. What are my assets? Mark, did that question get answered for you?
And
Well, sort of, but yeah, I think it is. It's more the intangible, the customer list, the contracts.
Correct. And Mark, just to answer that question, we've sold businesses before that are nearly 100% goodwill. Goodwill plus some computers and office furniture and the like. The SBA will loan and buyers will purchase businesses that are nearly 100% goodwill. It's all about the ability to show what are the future earnings potential. Why is the value of this business transferable to a new owner?
Okay. Yeah, I'm remote, so we don't even have a building, don't have desks. Just a
Yep,
handful of computers.
yep, no problem. It happens all the time.
That was the only questions.
okay, awesome. Well, thank you, Don. Appreciate your coaching and your guidance on all of that. And on goodwill, real quick, Don, do we start or end with goodwill? Is that something we start with in the business valuation process?
No, we end with goodwill.
Yes, sir. That's right. Okay, friends, let's dive into the nuts and bolts of how a business valuation is put together. And the overarching theme you're going to see here is we have to identify the profits and the cash flow of the business. Okay, and we need to normalize the expenses and the revenues of the business. And what we're going to walk you through here is the process, the high-level process of how we do that. So a couple things to keep in mind, especially for our sellers, right? So as listing agents, we're going to help you get it all packaged up, cleaned up, everything's organized, transparent. We're ready to go to market. And we're going to have a price that we agree to that we go to the market with, okay? But at the end of the day, the market is going to determine the value. Could be timing, may work in our favor, may not. Could be buyer pool. All those things are going to have a say. But ultimately, at the end of the day, the market is going to determine the value of our listing. A business is worth its transferable value. Very, very important to understand that. It's why it's so important for us to identify it and be able to share that with buyers in a manner that is easy for them to understand and identify. But not just the buyers, because as you see on the bottom, the lenders are going to have a say in this scenario as well. A lot of sellers don't really realize that not only that we're in competition with the entire market. So whatever our listing may be, it's going to have certain characteristics of it. It's going to have an ownership model that's appealing. It's going to have cash that it's generating. But it's not just standalone all by itself or even with another business of the like. It's going to be competing with other businesses that also have characteristics that these buyers are seeking, and they might be looking at, most are, a diversification of different businesses at the same time. So we're competing with other businesses as well. And as I mentioned, the lenders are going to have a say in what this business is worth, right? So we're helping identify from a valuation standpoint based on multiples, and we're going to figure out how to do that, and seller discretionary earnings. The lenders are going to want to make sure this business cash flows, and it's going to support a loan, and it's going to support the lifestyle of the owner. So they're going to do some reverse math on theirs, which is why Don and I really send all of our listings through the banking process. We pre-qualify our listings so they can poke holes and pull strings and get it ready for the lending side. Because when we have great buyers ready to go, we don't want them running into those hurdles along the way. What is value by a multiple of earnings? Okay. Earnings times some sort of multiple, we're going to identify that, ultimately equals the business value. Okay. And through this process, we're looking to identify apples to apples comparisons. There's going to be some slides that come up here in a little bit that show us industry type of metrics, as well as the size of the business based on revenues, based on profits, etc. Does it come with real estate, etc. So, and the two most common types of earnings are going to be EBITDA. I'm sure we've all heard of that. EBITDA is really going to apply to bigger businesses, typically greater than 10 million, greater than 20, but more middle market companies that are professionally managed. Okay. Whereas in small business, right, that 1 to 10 million, it's going to be really predicated on what the seller's discretionary earnings look like. And Becky, was that your hand that you had a question?
Yep, so Carol asked in the chat, is there a place to buy, sell tiny businesses? Say a business that is worth less than 50,000. My business would never even fall into the small business category if that value starts at $1 million.
Yeah, Don, do you want to? I mean, I've got perspective, but you may have some too.
Yeah, so there is a marketplace called Biz Buy Sell, BIZBUYSELL.com, and anyone can go out and place their business on that. So I would recommend starting there. And you know, at $50,000 in value, I don't know what your profits are. I don't know how you arrived at that number. But the question is, because we talk a lot about what a business has to do, if it has to support a lifestyle, there is a question about, you know, what will the business that you're talking about do? But for right now, to give you a good answer, I would go look at Biz Buy Sell and study the offerings that are out there.
Yeah, it's a great answer. And they're typically non-broker assisted, for sale by owner type of scenarios at that level. You're welcome to reach out to us afterwards. We may have some tools to be able to help you with that. I've got a couple myself. I'm glad to try to help you. But seller discretionary earnings when it comes to small business, right? So let's figure out what that means. Well, what is seller discretionary earnings? At the end of the day, it's all the financial benefits that one working owner from the company can derive from their business, okay? And these SDE calculations are going to assume a few things, but most notably, we're going to normalize the operations, right? Normalize the revenues, normalize the expenses. We call that recasting as well. And it's going to make an assumption that there's no debt, okay? And we'll show you how that works. Typically, seller discretionary earnings are built on historical information. Now, that too assumes that the company's been around for a while. You'll see the types of documents and the length of time that we go back and how we put that together. But we also sell companies that are newer and they've taken off like a rocket ship, and so that would be a little bit of a different approach, but it's going to be based on historical performance. SDE, anything that we're going to factor into a seller discretionary earning category is going to have to be listed somewhere in the financial statements or the taxes. It's got to be documented. It's got to be tracked. Seller discretionary earnings will not include unreported income, cash that you receive from customers that no one knew about, you know, tips, things like that, restaurant businesses. And ultimately, the term discretionary is critical. And most notably, it's because two owners are really never the same, right? I mean, everybody's going to pay themselves in a different way. You know, when we work through a seller discretionary worksheet with our sellers, and it's a profit and loss statement, and there's 50 items on that P&L. If 30 of them have seller discretionary earnings baked into them, it's going to be a problem. We're going to help them understand that. Ideally, it's going to be the more common traits that we're looking for, and it's going to be a lot less of 90% of their income what was sort of tucked into these different expense categories as a way to sort of avoid paying taxes. But no two owners are the same. So where do we start? We're going to start with financial documents to put this picture together, okay? And we're looking for 3 to 5 years, if they exist, of tax returns, okay? And P&L income statements. I'll explain a little bit as to why. Balance sheets, accounts receivable, accounts payable, monthly sales is a great indicator. It's going to help us understand seasonality of the business. And these models are typically built on accrual-based accounting. Tax returns are going to come into play because we're going to start with a bank, okay? Whether our buyer ultimately needs a loan or not, it's a healthy strategy to get a perspective from a bank on here too. And they're going to balance, what they're seeing on tax returns and what they're seeing on your P&L statements. And because they're going to do really a cash flow analysis, whereas we're trying to identify all the profits that I mentioned earlier, right? All the profits and all the cash flow that are truly in this business while we're normalizing the expenses and revenues. Becky, do we have a question we need to tackle right now?
We do, and you may get to this, I'm not sure.
Sure.
If I want to sell my business but currently have a balance on a PPP loan, should I pay it off or offer as a transferable loan and reduce from the from the price of the business?
Listen, my perspective, here's also what you're going to hear. Every deal is different. Everything's negotiable. Every situation is unique. So there's more context that I think we would need to be able to give you. My canned answer is you're likely not going to be able to transfer that PPP loan to somebody else, and it's probably going to have to be dealt with at closing. Don, what are your thoughts there?
Oh, for sure, you cannot transfer a PPP loan. Now, when you use the term PPP loan, I'm wondering because for the most part, all of those were forgiven. And so there shouldn't be a liability in most cases. But if yours was not forgiven for some reason, yes, that would be a liability retained by the seller and your responsibility to deal with it.
Yeah. And sometimes we say PPP, and I've just say this from my own clients, and they'll get an employee retention tax credit, and they're wondering how to figure that out. We'd be glad to help you offline, walk through that, and understand your situation better, and try to give you some guidance on that. It's a good question, really good question. Calculating SDE. So what are the components, right? Again, we're looking to find the profit and the cash flow of the business. And we're going to start with the net operating income, and we're going to build from there. So we're actually going to build our own example here together. So we're going to take the net operating income from the profit and loss statements. We're also going to evaluate the tax returns and make sure things are lining up. And then we're going to add the owner's W-2 salary and the owner's benefits. Okay. And that's going to include their portion of the payroll tax, that type of thing. We're going to add in interest, taxes, depreciation, and amortization. These are standard add backs, non-cash expenses, but taxes and interest, right? So everybody's going to have a different approach here. If we're showing taxes that were paid from the P&L, we're going to handle that a certain way. Interest, that's one of the most common, right? So we go into this assuming that there's no debt. But if the buyer, or excuse me, if the seller has a loan and they're paying interest on that, that's going to be one of the pieces that we're adding back to the seller discretionary earnings column. Plus or minus on the non-operating expenses or revenues. So it depends on what they are. If these are personal expenses that are being run through the business, we're going to address those line item by line item with the seller to ultimately get, it's truly a balance. Like, is it going up? Is it going down? We have to justify it all. Everything's not an add back. Some of them are going to be deductions from the seller discretionary earnings. Okay. If we had a PPP dollars, for example, back to that, and we got $150,000 in 2021, and it's showing as at the bottom of our P&L, down by our net operating income as cash. We cannot count that as that's not part of the normalization of that business P&L. So we're actually, in that case, we're going to have to deduct the PPP money that came in because it effectively inflated their profitability on paper. So again, we're back to normalizing expenses and revenues. So if we have a situation where, we have a huge purchase at the end of the year, that's going to make that year swayed. It's going to look like our expenses may have been out of whack. It's going to reduce our profitability, but maybe in Q1, we actually build the project for that. But the expenses were last year. Well, now the next year is going to be overinflated and look like, the profitability is higher because we don't show the expenses tied to that. So part of what we're doing here is we're normalizing expenses. We're going to identify that, flatten it out, recast the financials. And so we can show, normalized level activity year over year. And again, when we can add back reasonable, again, provable discretionary expenses. So what you'll find from a seller standpoint is when you build your seller discretionary earnings total, okay, you're going to get two opinions, really three, one with us, but you're going to get a second with the buyer. Okay, your buyers are going to be a little bit more understanding to maybe all the different things that you're factoring into your seller discretionary earnings. The more they can understand, yep, I would run my personal auto through there too. Yeah, I'm running my whole family's cell phone bill through there. Whatever they may be, we'll walk through some of the categories together. But the bank is going to have a different opinion. They're not looking at it from an SDE standpoint. They're looking at it from a cash flow standpoint, and anything that they see that they feel, you know what, the next owner is going to do the same thing, we're not going to factor that in. They might discount it. So at the end of the day, our coaching to our sellers is they need to be reasonable and they need to be provable. So what is net operating income? I mean, the shortest version of it's the bottom line of our profit and loss statement of our business. And again, it needs to align with our tax returns. If not, we have to be able to reasonably explain why not. But the net operating income, especially for small businesses that are privately held and run, to support a family and generate as much cash as they can, they're often deliberately low as a tax reduction strategy. So Don and I we're not the tax police. That's not our job. We will provide coaching and guidance to our clients to help them understand what's fair and reasonable. The bank is going to have an opinion. Here they are again. The bank is going to have an opinion about our tax reduction strategy. And so they may or may not accept everything we're putting forth in seller discretionary earnings. So that's some of the how we get here. Now let's dive into an example and take a look at how we go from net operating income to seller discretionary earnings. Okay. And then we're also going to take a look at how we get to multiples. I see we got about 20 minutes left, so I'm going to ask you to hang in there with me. I'm going to start skipping through pretty quick. Okay. So apologize. We're starting with net operating income of $275K. As I mentioned, we're going to add the owner wages and their portion of the payroll tax. You guys are going to get a copy of this at the end. Any owner-specific retirement plans, okay, we get to add that back too. Distributions are not included. That's a balance sheet thing. But with these two categories here, with their W-2 wages and their payroll tax and family insurance, things like that, that added another $125,000 to our net operating income. Those were line items in the P&L. Now we're at $400,000 in seller discretionary earnings. Okay. We're going to make some other financial adjustments in the P&L. We're going to add back depreciation and amortization, and we're going to add back the seller's interest expenses because we're assuming no debt in this calculation, in this model, and the buyer may or may not have that structure. Any taxes paid, also, those will be adjusted in the SDE calculations. But we're also going to remove one-time income. I gave the example earlier about the PPP. That would overinflate our financials. That's an example where we'd actually have to back it out. But between depreciation, amortization, and interest, that added another $50,000 to our seller discretionary earnings. Okay, so now we're at $450. We started at $275. One-time expenses or revenues. Well, maybe we relocated or remodeled our business. That's not something we had to do. It's not normal and customary part of our operations. So we're actually going to add that back. That's going to be an add back to SDE. Maybe we had a one-time legal or accounting matter. Maybe somebody slipped and fell. We had to settle a lawsuit. It was easier for us to write a check for it. Okay. Inventory adjustments. So if we have obsolete inventory and we're writing that off, we're going to make an adjustment back to, or we can make an adjustment back to our SDE as a result of that. Accelerated depreciation, won't spend too much time here. The short version is, there's tax laws in place that will allow people to write off up to $1 million all in 1 year, take a massive tax deduction. Well, that wouldn't be normalized. So we're going to have to address that. That would be something that we're going to deduct likely or normalize and fix back in our recast of financials. and then a gain or a loss of assets. So in this example, we sold a company vehicle for $10,000. We're ultimately going to deduct that from our SDE calculations. But we did relocate our business last year, and we did have to write a $10,000 check to solve a legal matter. It was just easier to do. So our net SDE running total right now is all the way up to 500,000. Okay. Back to the process of normalizing our expenses. We want to make the P&L reflect typical operations. Here's some examples of common adjustments that we would make. But down here at the bottom are a couple that we see often, right? Maybe there's a spouse that's doing accounting work that's really needed for the business. And the spouse is doing it, and there's no financial accounting for the cost behind the efforts they put forward. Well, the buyer's going to have to deal with that. In this case, we're going to deduct $25,000. That would be a reasonable amount that Don and I had to pay somebody to handle the books. Market rent, very common. We own the building. We're charging ourselves $1,500 a month in rent, whereas, it's really $4,000 a month is more of a market rate. We're going to have to make an adjustment there. It's got to be fair and reasonable, right? So now it's deducting ultimately $50,000 from our running SDE total to account for those two categories. So now we're down to $450 in our SDE. And then here we're going to add discretionary expenses. Okay. So I talked about it earlier. These are the common categories: personal and travel entertainment. They're small business owners. They're probably going to travel and try to make as many of those. It happens all the time. So travel, charitable contributions. That's a highly discretionary item for a business owner to make. The new buyer may not do that. Cars, meals, tuition. We see new home patios. I just sold a service-based business where the owner put $200,000 of his income on top of his roof, and it showed up as a cost of goods. Things happen. So we go through the process of understanding that, helping the sellers, and then we're going to have to help the buyer understand what happened there too. Buyers and lenders, again, they're going to have different opinions. But look, in this page here, we're adding another $25,000 back to our seller discretionary earnings totals. So now we're up to $475,000. Okay. How did we get from net income to SDE? Here it is in its simplest form. We started at 275. We added in all those blue items that we talked about. We had some deductions along the way. And ultimately, our seller discretionary earning total is now at 475. Remember, we started at 275. Okay, huge swing. Okay, that's how we got to the seller discretionary earnings total. Now we have to deal with the multiplier, right? So where are we going to get that from? Your business is unique, sellers, right? Like, whose isn't? Everybody's business is unique. So again, we want to get it as close to apples and apples as possible. The typical multiple range for the businesses that we see is 1 times to 4 times the seller discretionary earnings number. That's going to be highly influenced by a couple things. The ownership model, right? If I'm the owner and I am working in that business 60 hours a week and it requires me to spin the proverbial wheel for it to make money, I can't really get away on vacations often. It's highly dependent on me. You're going to see the multiple down, right? However, when I'm preparing my business for sale, or if it's already built that way, the closer I can be to flipping the keys to Jim, right, as the new buyer, the desirability goes up. And it's going to absolutely affect the multiple of my company. So ownership model and SDE number, right? Those two things are going to have critical impacts on the ultimate selling price and the multiple. Larger businesses, larger multiple. 2.2 is the national average. When you're visiting with friends and you're just trying to understand, well, I make about this much money and I got about another 100,000, and the SDE things Don was telling me about, 2.2, something like that. Yeah, you're probably in the right ballpark. Rules change for mid-market businesses. We'll call them mid-market. We start to get into 10, 20 million professionally managed companies. It's going to start to change. Okay. And as Don mentioned earlier, if you're in tech, that's going to be unique. Specialty food products, that, there's some categories like that that'll also have an impact. Here's some statistics by the size. What do I mean by size? I mean revenue and I mean income for the company. Okay. And again, you're going to get these, so I'm not going to belabor it, but you'll see the higher the revenue, the higher the multiple, and certainly the higher the SDE, right? Those have an impact. We could sell 10 million bucks. If we're not making any money, it's not going to be worth a ton of money unless it's to a strategic buyer. Here's some statistics by industry. So you can take a look here, find your industry across all sectors, average multiple about 2.2. There's a lot of factors that go in here. So what's the net result of our valuation example? So we went from 275 to 475. And our example multiple based on this business that we're listing, based on the industry, based on location, types of all those things put together, 2.5 is the average multiple. So our selling price is pushing 1.2 million. We're at 1.187. And that, my friends, is how we got to SDE. What does it mean? What's a multiple? How does this come together? And show me the money. What's it worth? So Don, take us away.
Okay. Yeah, I think it's really important. And as brokers, when we do a valuation as part of working with someone to get a listing, everything is line item. And for a number of things, we will ask for documentation. If somebody says, I bought a truck for personal use this year, and I put it on my P&L as an expense, we'll say, give me the receipt for the truck. Not I bought a $60,000 truck, and then we find out it was 51.5, or it was 70. We want to know exactly how much the truck was, and we're going to use those exact numbers. So a lot of this, when we say provable, we're talking about there's going to be documentation to back up all of these discretionary elements that we are going to change from the net income line to something else. Okay, some of our key takeaways here. First of all, if you want to increase the value of your business, increase the profitability. You don't have to buy more equipment. You have to use your equipment more efficiently. You have to get more customers. You have to cut your costs down, because your business is not going to go up in value as a result of having more equipment. It's going to go up in value as a result of having more profits. So be very attentive to that. Don did a great job talking about reducing reliance on the owner. We say, make yourself dispensable. Make the business so you don't have to be there. You can take a 1-month vacation and the business is not going to fall apart. The less reliance on the owner, the more valuable the business. Document and systematize. A lot of businesses are complex. There's complex manufacturing processes, or there's complex, we see it in restaurants where recipes and following those recipes is very important, and how a plate is actually assembled to be delivered to a customer. The more that those kinds of things, simple as they might seem, are documented, and there is a process that the new owner can follow and rely on to continue the success that the previous owner had, the better. Keep clean, professionally prepared financials. We understand. Sellers, we talked a little bit earlier about the qualitative nature of your relationship with your business, and that kind of flows down to the financials. You don't need to look at your financials to figure out if you're short on inventory for something. You just look at the shelf. You know when you've got enough people or don't have enough people. You just know these things. Buyers won't. Buyers are going to operate and depend on those financials. So the more clean and professionally prepared they are, the more they really reflect how the business operates, the easier it's going to be to sell the business to a buyer. Maintain customer and product diversity. If you do $10 million of business at $2 million of annual profit, and you only have one customer, you're going to have a hard time selling that business, because the buyer is going to be totally scared that they're going to lose that customer. What's the guarantee that they can keep that? Whereas if you do that same 10 million with 2 million in profits, over 60 customers, none of whom has more than 5 or 6% of your revenue contribution, all of a sudden you've mitigated that risk. So maintain product diversity, maintain customer diversity. It matters. And if you have contracts, especially contracts that evergreen, I mean, that's just wonderful. You could say, yeah, I take in $1 million a year, of which 850,000 is under evergreen contracts. And my rollover ratio is about 94%. Wow, that's demonstrable risk mitigation for a buyer. That helps them know what's going on. So to the extent that you could do that, all of those things can increase value. They don't all apply to every business, but they apply to different businesses, and something will apply to any business. Okay, Don?
Yeah. So keep in mind, yeah, go ahead, Don. I apologize.
This is all yours. Go for it.
Yeah. So keep in mind, and we're here at the end. I did add a slide right after, the questions slide. So you'll get a copy of this. But that slide is going to give you 11 different key characteristics, areas that you can directly impact the value of your company, things that you can do moving forward, be aware of. Okay. But as we wrap up today, the importance of a shared vision between the buyer and the seller and the lender. And we used to have a slide in here that was beautiful, and I wish we could show it, but the reality of it is buyers look at it differently than the seller, and then you have the lender, right? So getting all of those folks together, critically important. We bake that into our process. Asset sales are the most common, right? SDE equals net income, right? Plus the add backs, plus or minus the adjustments, gets us to our SDE number, and our SDE times the multiple, right, based on the size, location, profitability, etc., equals the business value, apples to apples comparisons. Multiples are driven by size, industry, and the 11 influencers that are at the end for you. Goodwill is the difference between the price that we're listing at and the value of the assets. That's the gap there. There's 3 sources of funds in these deals. The buyer brings money, the lender brings money, the seller may have to serve as the bank on part of that. Seller financing is what that's referencing. And SBA is part of most deals and can be your friend. It's as long as things are put together correctly and they're vetted and transparent. SBA, look, they're looking to do loans. They're not looking to, for reasons to say no. They're looking for reasons to say yes. And even when we pre-qualify them, they don't just say no. They'll give us a list like, hey, these are the 4 or 5 things that we need more clarity on. We need you to help us understand this better. So we see SBA in what, Don, 90% of our deals, maybe more than that?
Oh, yeah, I think 90% is probably a good number.
Yeah.
I do want to add one thing on that last slide.
Sure.
That 4th bullet that says business value apples to apples. I really want to make sure people understand brokers all over the country are doing the same thing to calculate sellers' discretionary earnings. There may be some small variations on how one broker does it and another broker. But in essence, that apples to apples is so that a buyer who's going out in the marketplace, who might be looking at 2 or 5 or 10 businesses before they finally buy one, can compare the return on investment for a given business through that SDE calculation. They can understand that this is the amount of economic benefit that's going to flow to me, and they can directly compare it. They couldn't do that just by looking at the net income line, because the net income line is a partial story and it's arbitrarily low as a tax reduction strategy. So just keep in mind, buyers are looking at multiple businesses, and they're highly qualified to analyze your financials and other business financials. And they're going to gravitate towards those opportunities that they feel offers the best value. So it's really important to keep that in mind. Transparency, Don's brought that up several times.
Yeah, critical. We have some time for questions. I'm sorry we didn't leave more, but we're glad to dive in with the time we have left.
Anybody?
And certainly offline questions we're always willing to take as well. Feel free to contact us.
Yeah. Yeah, we appreciate the opportunity to present to you. We hope that we can be helpful. Don and I build our businesses on referrals. Please keep us in mind if you're looking to sell your company or if you just need some help. You have questions along the way, we probably have some tools that can be helpful for you.
Well, thank you everyone for joining us. If there are no further questions, I do want to let you know. Well, first of all, Don and Don, thank you so much for this presentation. I know knowing the value of your business before selling or before buying a business is so important. We appreciate that. For everyone, I've recorded this session, so I will go ahead and get that downloaded. It takes a couple hours, so I will try to get that to you this afternoon, along with the PowerPoint presentation. And if you have not signed up for next week's session on offers, contracts, and closing, you can still do that on our website. We'd love to see you there. If you have any questions, you can also reach out to me at the Larimer SBDC. And I hope you all have a great afternoon.
Thank you very much, everyone. Thank you for the questions and for being with us. Thank you.
Have a great day.